Trading a stock into the gap. This is probably one of the more simple strategies that you're going to come across when it comes to trading. Gaps are identified as a disconnect on the daily chart time frame between two candles. So if you notice, all of these candles in some way, shape, or form are touching. Wicks overlapping wicks, bodies overlapping bodies, bodies overlapping wicks. They're touching some way, shape, or form, right? It's not until right here that you have a disconnect between two candles found on the daily chart time frame. That, my friends, is a gap. I like to identify my gaps with big gray shaded boxes. Just makes it easier to see. If I zoom out on the chart, I can see there's a gap down here. I know that there's another gap up there. It makes it easier to see. So I would recommend that you identify your gaps this way. What we're talking about in this video is trading a stock into the gap. Therefore, criteria 1 is that we have to have a gap. Criteria number 2 is that the stock must be trading just below that gap area. Side note, the bottom side of the gap, which is right here, and your top side of the gap, which is up here, are going to act as natural points of support and resistance. And that's it. Those are the only two criteria that need to be met for this strategy to be in play. Number 1, identify a gap. Number 2, the stock must be trading very close to the bottom side of the gap. So we'll move to the 5-minute time frame and see how we could have traded this up into the gap for a gap fill. So remember, the gray shaded area denotes our gap area. When the stock Apple breaks into that gap area, we don't chase the move up. We want to try to get the entry as close to the bottom side of that gap area as possible for the gap fill to the top side. Therefore, if you're taking the entry close to the bottom side of the gap, your stop loss is going to be just below the bottom side of the gap, and your reward is going to be any move up into the top side of the gap. Reward size is here. Risk amount is here. You can tell that that's way more reward than the risk assumed. Therefore, it's worth it to take this trade. You always have to assume risk when you're taking trades. So you have to ask yourself, at what point can I enter a position and assume the least amount of risk possible? If I know that I have to take on risk, how can I enter the trade and take on the smallest amount of risk? By entering at the bottom side of the gap for a gap fill, which is going to be a natural point of support for you. Essentially what you're saying is this trade should work for me right away and I'm going to be green this entire time, or it's not and I'm just going to cut it right away. Small risk, high reward. Let's look at another example. Criteria number 1 is that we have to find a stock that has gapped down on the daily chart time frame. Therefore, we're looking for a disconnect between two candles. In this scenario, we have a disconnect between this candle here and this candle here. We're going to highlight our gap with a big gray shaded box. Keep in mind that the bottom side of the gap and the top side of the gap are going to be natural points of support and resistance. So we'll draw two trend lines there to remind ourselves of that. And criteria number 2, the only other criteria that needs to be met is that the stock must be trading just under the bottom side of the gap. Following day, we're going to be looking for a trade known as a gap fill. So let's move to the 5-minute time frame and see where we can identify an entry. Remember, the day prior, the stock is trading very close to the bottom side of the gap. We see that acting as a resistance right here. So the next day, which would be on this day here, we're looking for the gap fill trade idea. We don't trade in the first 5 minutes, but the idea here is to get the entry as close to the bottom side of the gap as possible, given that we know that that's going to be a natural point of support. So you take your entry on this candle here with your stop loss just below, and your profit margin is anything up into the gap for the gap fill. So not accounting for the whole move, let's just account for a fraction of the move. Your amount of reward looks like this versus your amount of risk from the entry down to your cut point looks like that. Reward versus risk, it's more than quadruple to 1. Again, what's so great about trading a stock into a gap fill is that you're taking on such little amount of risk, and either that trade is going to work for you right away and you will be green the whole time, or you're just going to cut it right away and you're going to take a very small loss, a very small mitigated managed risk. So I hope you took notes. Go back and practice this stuff. Try to identify some gap downs on the daily. Look for stocks that are trading close to that bottom side of the gap and then trade it into the gap the next day for the gap fill. This is one of the higher probability setups and strategies out there. Hope the video's helped and that you took some good notes, and I'll see you in the next one. Cheers.